Welcome, Andrew. The second quarter was another strong quarter for markets. How did the infrastructure sector, and more specifically your fund, perform?
Thanks, Joe. Pleasingly, it was another strong quarter for the sector, which outperformed global equities. Global bond yields dropped during the quarter, which benefited the longer duration infrastructure assets. Our fund outperformed the sector, driven by strong stock price performance in several of our larger positions. These included Hydro One, a Canadian electricity transmission and distribution provider, Fraport, the owner of Frankfurt Airport, as well as a portfolio of global airports, and Getlink, which owns the channel linking the UK to France.
Andrew, one area you and the team talk about is a large need for further capital investments in the listed infrastructure sector. Why do you see this as such an attractive aspect of the investment?
You're absolutely correct that there is a very large capital expenditure opportunity for our sector. Indeed, we calculate that in 2019, the companies on our focus list will invest approximately $200 billion in organic capital expenditure, which is more than 10% of their combined market capitalisation. These organic investments are particularly valuable for an infrastructure company, as in most cases, the existing asset owner is the only provider who can make such capital investments, whether it's upgrading an existing water network, building a new airport terminal, or widening a road. And so as there is not a competitive process in deploying this capital, the company should almost always be in a position to earn a return which is above its cost of capital, thereby creating value to investors. One example of investments that are currently very accretive are those made by US regulated utilities, as the allowed return on equity is on average close to 10%, compared to current long bond yields of just over 2%. US regulated utilities have typically been growing their asset bases at 4 to 6% per annum. But considering the attractive return on equity available, we've concentrated our investments into faster growing utilities. For example, our largest US regulated utility position is Atmos Energy, which is forecasting growth in its asset base of 13% per annum over the next 5 years.
After a strong start to 2019 for the listed infrastructure sector, how do valuations now appear?
Valuations have clearly become more expensive over the last 6 months, and so when looked at in isolation, we believe that valuations for the sector have changed from being somewhat attractively valued to now being around fair value. Relative to other investment opportunities, we remain more positive. For example, there's ongoing evidence that listed infrastructure assets trade at material discounts to where equivalent assets trade when transacted directly. This was reinforced during the quarter with a number of direct infrastructure transactions occurring at prices at substantial premiums to the equivalent listed companies. These transactions included North American pipelines, storage tanks, an airport, as well as a regulated electric business in the US and a regulated gas distribution business in the UK. Relative to global equities, we also believe that listed infrastructure valuations are attractive. The sector trades at a 13% higher EBITDA multiple than global equities, but considering the materially longer duration of the infrastructure assets and the lower cash flow volatility, we believe that this level of premium is quite modest. And finally, my comments have all been about the sector in general. But within the sector, we do of course continue to see what we believe to be mispriced individual stock opportunities.